Here's a number that's going to bother you. Over the last 30 years, the stock market has returned roughly 10% per year. Real estate? About 4%. So mathematically, stocks win. It's not even close. And yet, if you look around at the people who have built real generational wealth, the kind of wealth where they never have to think about money again, a huge portion of them didn't do it through index funds. They did it through property. How is that possible? How does the investment with the lower return produce more millionaires? That's the question almost nobody is asking correctly. And today we're going to answer it. Most people have this debate completely wrong. They compare real estate appreciation to stock market returns and call it a day. But that's like comparing a car's top speed while ignoring whether it has an engine. The real comparison is so much deeper than that. We're talking about leverage, cash flow, inflation, tax advantages, liquidity, effort, compounding, opportunity cost. These are the forces that actually determine which path makes you wealthy. And here's the thing, nobody tells you both answers can be right. Depending on who you are, one of these paths will make you rich. The other one might just make you broke trying. So let's break it down properly. Think about how most people approach this decision. They Google it, get a listicle, and walk away thinking they understand it. They don't, because the answer isn't in the data. The answer is in you. What kind of investor are you? What is your relationship with debt, with risk, with uncertainty? Those questions matter more than any return percentage ever will. Let's start with stocks. Because on paper, they're almost too good. The S&P 500, the index of America's 500 biggest companies, has averaged around 10% annually for decades. That includes crashes, Black Mondays, dot-com collapses, a global pandemic, financial meltdowns. Through all of it, 10% per year, still standing. Now here's where the magic happens. Because of compound growth, money in the market doesn't just grow, it accelerates. Your returns generate returns. Then those returns generate returns. It's a snowball that keeps getting bigger the longer it rolls. And the best part, you don't have to do anything. No phone calls, no maintenance, no tenants, no 2 a.m. emergencies. You invest, you wait, the market does the work. You can diversify instantly across thousands of companies, across every industry, across every country with a single click. That's extraordinary. That is genuinely extraordinary. And if you want to exit, you can sell in seconds. The money is in your account by the next morning. Liquidity like that, real estate will never compete with it. So yes, on a pure returns per unit of effort basis, stocks are almost unbeatable. But this is where things get dangerous. Because there's something real estate does that stocks simply cannot. And when you understand it, it changes everything. But before we get there, one more reason stocks are genuinely powerful: psychology. The biggest enemy of any investor isn't the market, it's themselves. Stocks let you automate everything. Set up a monthly contribution. Forget about it. For a certain type of person, that is everything. But here's what changes the math completely. Let me show you the single most powerful concept in personal wealth building. It's called leverage. And stocks don't have it. Real estate does. Here's what I mean. You want to invest in stocks. You have $50,000. Guess what you control? $50,000 in stocks. That's it. Dollar for dollar. No more, no less. Now you want to invest in real estate. You have that same $50,000. You use it as a down payment on a $500,000 property. You now control a $500,000 asset with $50,000. That's 10 times leverage. Legally. With a bank's money. Now watch what happens next. That property goes up just 5% in a year. A modest, boring, completely normal appreciation rate. 5% of $500,000 is $25,000 in new equity. Your original investment, $50,000. Your return on that money, 50% in 1 year on a property that barely moved. This is the math that the stocks only crowd ignores. And it gets better. Because while all of this is happening, who's paying your mortgage? Your tenant. Every single month, someone else is paying down your debt, building your equity, growing your net worth. You're not just investing. You're running a machine that builds wealth in multiple directions simultaneously. And here's the part that almost nobody talks about. Inflation. When inflation rises, the value of your property goes up. The rent you charge goes up. But the mortgage? It stays fixed. That $400,000 debt you took on today, In 20 years, with inflation doing its thing, that debt is worth far less in real terms. You borrowed expensive dollars. You'll repay them with cheap ones. Real estate doesn't just fight inflation, it weaponizes it. That is the power of leverage. And that is why people with no finance degree, people who barely know what an ETF is, have become millionaires through property. There's also forced equity. Every mortgage payment your tenant makes chips away at that loan balance. You're mechanically building equity month by month, whether the market moves or not. And then there are the tax advantages. Depreciation. Mortgage interest deductions. 1,031 exchanges that let you roll gains from one property into another tax-deferred almost indefinitely. The government literally built tax breaks into real estate that don't exist for stock investors. Leverage, tenant income, inflation protection, tax advantages, forced equity. 5 streams of wealth simultaneously from one asset. But here's where I have to pump the brakes. But let's be honest, because if I made real estate sound like a guaranteed, effortless money machine, I'd be lying to you. Here's what the real estate influencers on Instagram don't show you. The roof that needs replacing. $15,000, gone. The tenant who stops paying and takes 4 months to evict, that's 4 months of mortgage payments coming out of your pocket. The vacancy period, when the unit sits empty and every day costs you money. The property taxes that creep up every year, the insurance, the maintenance, the plumber at midnight. And then there are the transaction costs. Buying a property costs you 2 to 5% in fees. Selling costs you another 5 to 6%. You can lose 10% just entering and exiting a position. Real estate is not passive. Let me say that again. Real estate is not passive. It is a business, and if you treat it like anything less than that, it will punish you. And if interest rates rise like we've seen in recent years, your numbers can flip completely. A deal that made sense at 3% can be a cash flow nightmare at 7%. Plus, if you ever need to access your money quickly, you're stuck. You cannot sell a fraction of a house. You cannot liquidate in 24 hours. Real estate ties up your capital for a long time. So yes, the leverage is real. The wealth-building potential is real, but so is the grind, and here's the part that breaks most first-time landlords. It's not the big disasters, it's the slow bleed. The $400 repair here, the $800 repair there, the insurance increase you didn't budget for. Every one of those events alone is manageable, but they never come alone. They cluster. They stack. And if your margins are thin, they can wipe you out. This is why so many people try real estate, lose money, and spend the next 10 years telling everyone it doesn't work. It works. But only if you go in eyes open with reserves, research, and the right numbers from day one. But there's one advantage stocks have that real estate investors almost never talk about. And it's not the returns. It's not the liquidity. It's what investing in stocks does to your mental bandwidth. When you hold index funds, you hold thousands of companies across every sector, every geography, every economic cycle. If one company collapses, you barely notice. If one industry crashes, you're diversified across dozens of others. You can't do that with a $500,000 property. That is one asset, one location, one market, one risk. Stocks give you something priceless. Emotional freedom. No 2 a.m. calls. No dealing with difficult people, no lawsuits, no maintenance, no negotiating with contractors. You can live anywhere in the world, travel for 6 months, disappear entirely. And your portfolio? It just keeps growing, quietly, without you. That kind of peace has a value that doesn't show up in any return calculation. And let's talk about scalability. You can't buy half a house, you can't start with $100 in real estate, but you can start investing in the stock market today, with whatever you have. And as your income grows, your contributions grow. No approval needed, no down payment, no bank. The barrier to entry is essentially zero. For someone just starting out, that matters enormously. And there's one more thing stocks have that almost nobody quantifies: time. Every hour spent managing a property is an hour not spent building your career, your business, your health. Stocks don't ask for your time, they ask for your capital and go to work while you do the same. That compounding effect on your time and energy is invisible in every spreadsheet, but it's very real. So which one wins? Here's my honest answer. The wrong question is which investment is better. The right question is which investment is better for you, because these two paths don't just require different money, they require different people. Stocks are the right path if you want true passivity and minimal management, have a high income, and want to invest efficiently without complexity. Value simplicity, flexibility, and liquidity. Play a long game and have the patience to let compounding work. Don't want a second job managing properties. Real estate is the right path if you are comfortable with leverage and understand how to use it responsibly, want cash flow and tangible physical assets, have an entrepreneurial mindset, and enjoy active problem solving, are in a market where the numbers actually work, can stomach the illiquidity and operational demands. Most of the wealthiest people in the world use both. They build their stock portfolio for passive, scalable growth. And they use real estate for cash flow, leverage, and inflation protection. It's not either slash or, it's both, sequenced intelligently. Start with one, master it, then layer in the other. The worst thing you can do is nothing. Sitting on the sidelines waiting for the perfect investment is how the middle class stays middle class. Both paths lead somewhere. Inaction leads nowhere. Let me leave you with a framework. In your 20s, time is your greatest asset. Stocks are almost perfectly suited for this phase. Low friction, high scalability, maximum compounding runway. In your 30s and 40s, you likely have more income and stability. Real estate starts making more sense. You have reserves for the bad months. The discipline to treat it like a business. The smartest move isn't choosing one path, it's knowing when to use each one. A stock portfolio that funds your real estate down payment, a rental property that generates cash flow you invest back into the market. That's not a theory. That's how wealth compounds fastest. They say investing is about picking the right asset. I disagree. Investing is about picking the right asset for the right person. Stocks will make you wealthy quietly. Real estate will make you wealthy aggressively. Both are roads. The only wrong move is standing still. Think about which path fits who you actually are. Not who you want to be on paper, who you actually are, how you actually think, what you can actually commit to. That's the real investment decision, and if this video helped you see it more clearly, you know what to do.